Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do another review of velocity banking, which is the hot topic not only for the week, but for the year, right? And I just keep making the same video over and over again because that's how we get better in anything. Remember that Bruce Lee quote, I don't fear the man who does 10,000 kicks just one time. I fear the man who does one kick 10,000 times. And this VB stuff, that's our one kick doing it 10,000 times, right? So in this video, we're just going to do an emphasis of what is not velocity banking, right? So I don't know if you knew this or not, but as human beings, our minds are drawn towards comparisons, right? That's how we understand things. So if I say, oh, it's line of credit, paycheck into line of credit, you might not really get what I'm talking about. In fact, a lot of people I think just overcomplicate it, right? So what is the complete opposite of velocity banking? I would just say it's two things. Number one, it's saving money, right? So when you do velocity banking like I do, after every single month, you get your checking statement or saving statement, and I get like, pretty much zero every single month. Why? Because I don't have any savings. My line of credit is my new savings account, savings with a quote, right? And so someone who would suggest to do the opposite of velocity banking would be Dave Ramsey, the number one most popular financial personal guru or whatever his name is or title. And it says step one, save $1,000 for your starting or emergency fund. Save $1,000. And we're going to skip this step with velocity banking. This is like the complete opposite. We're not going to save $1,000 and we're going to go to step two, which is pay off all debt, but with the help of a line of credit. Okay. So Dave Ramsey hates lines of credit. He hates credit cards. He hates, what else does he hate? He definitely hates home equity lines of credit, but we're going to use a home equity line of credit for this process. And then, so that's the one of the things I would consider to be complete opposite, saving money. And then number two, I would say is segregating our income. So let me just show you some spreadsheets that are real life case studies that I've gotten previously. So I remember when I first saw this, somebody emailed me a real life case study, $7,500 of income, $6,500 expenses, and then after every single month, about $1,000 left over. So things are a little bit tight there, right? And what happens with segregation of income is that your income comes into your checking account and then you use it to pay your bills, but because you have all these debts and you're splitting it in many different ways, you're essentially making minimum payments on everything, right? So this is why this person has, look at the number of debts: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15? No, 14, because these are general expenses. So your money is split into 14 ways. Now, what's funny is that the latest spreadsheet I got from a real life case study is like even more extreme than this. So when I see this, I was like, you're doing pretty good nowadays. When I see it, a little bit good income, okay, $1,000 a month, that's a little bit tight. This is the second case examples where it's like 5,400 $74 a month in income and $5,470 in expenses and $4.10 in savings. I was just blown away. So again, mind blown, right? So how many debts do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. Man, 22 debts. So our income comes in, our checking account is our main operating account, and then our paycheck gets split into 22 different ways. Technically 23 if you count the general expenses. And that's the thing that we're trying to prevent with velocity banking, right? Those two things, saving money. So if you're, whether you're in negative savings, which I'll show right now or in a few minutes, or your positive savings, we want that number to go to zero, right? And then we're going to increase something called cash flow, which would essentially be our savings if we're doing things the average American way, but we're not going to do that for today. So here's our example. Again, I always like to use high income examples, not because, I assume that you're making $9,000 a month, but I want to show you that as you make more income, if you manage your income inefficiently, but you know how to switch things around and to make it more efficient, then you'll be fine, right? But more income is always better. And the other thing too is that banks don't lend money to people who need it. So people are looking at these velocity banking strategies, looking for, how do you do this with low income? And, reality check. banks don't lend to low income people. They lend to people who have money and then hope that they're bad at managing it. So the whole point of this strategy is for cash flow and debt management, not for generating income. It's for eliminating debt to increase our cash flow, right? So let's take a look at our example. So we have $9,000 of income, $9,367 of expenses. Why can't I not click in the middle? Okay, of expenses. Man, this is going crazy. Okay, and then we have negative $367.51 in savings. So let me ask you, Dave Ramsey, how do I save $1,000 when I'm in the negative? Right? Like, how do I do it? Impossible, right? So that's step one. That's out of the question. And then step two, look at this segregation of income. How many debts do we have? One, two, three, four, five, six credit cards, two student loans, two auto loans, and a mortgage. And the mortgage is pretty cheap. Like, we'll assume that this is a I don't know, a med school graduate or a law school graduate, because you got $135,000 in student loans. You better be making good money and not be, not have majored in underwater basket weaving, right? But, some people, when they make that good money, they want to get like a $400,000 home. And you know what's funny? I paid off my mortgage under 3 years, and I can't even afford a $400,000 home. I don't even know who's buying those homes. So I think that's why, the mortgage is one of the most dangerous loans, because it's deceptive, because it takes up so little of our cash flow. And as real estate investors, if you're interested in real estate investing, you got to focus on that purchase price and not just on that monthly payment, right? So just a quick side note there. But look at how that income is segregated. And because it's so segregated and we have all this debt, that's why we're at negative $367 in savings. So we're going to do the exact opposite of this segregation. So we're assuming two things. Number one, same income. And like I said, whether you're in negative savings and in overdraft mode, right? Because the banks make a lot of money when you have to overdraft. Like, I remember I read in 2023, or a study that said in 2023 they made $5 billion in overdraft fees. So we're gonna have zero savings, zero. That's it, none, kapoom. Or you could leave a penny in there, right? Like, I remember talking to a banker, and the banker said, "Hey, leave actually just a penny in your checking account, because the banks, they might actually freeze your account because they think you're not using it." That's what they said. But we'll just assume, for the purpose of this exercise, we're going to have zero savings, okay? We're going to have zero savings. And then what we're going to do is just kind of have something called cash flow, whoopsie, which is income minus expenses. And you might be thinking, wait a minute, isn't this the same as our savings? We haven't finished the last step yet, right? And so if we take a look at this, what's the requirement? Number one is a budget. Number two, we need a line of credit as our main operating account. So what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. That's all it is, right? That's all a line of credit is. Oh, so let me go ahead and erase all this stuff. This is just from a previous demonstration. But all a line of credit, again, it's like a credit card is a line of credit, because you can use it, pay it back, and use it over and over again, right? But there's other types of lines of credit. It's not just credit cards. People only know about credit cards because they're the most heavily marketed. So anytime you see a sports event, you see brought to you by Visa or MasterCard, and they get just so confused, like, where do I apply for a personal line of credit? The same place where you get that Visa or MasterCard, right? Like, it's not anywhere different, but because, it's like going to McDonald's, and you know that you can get a burger and fries there, but did you know that you could get I think you get a salad or something? So you could probably get that, but it's just not as heavily marketed, because the big money is in the credit cards, right? Much more than the other products, although they do have other products, right? So what we're going to do is we're going to use our line of credit as our main operating account. Let's just assume we have access to $200,000 in lines of credit, $200,000, and you might be thinking that's insane. Right now, I have over 284,000. It's probably going to be over 500,000 in a couple months, because I probably will get a first lien home equity line of credit. And if you don't know what a first lien home equity line of credit is, it's like a huge credit card based on the value of your house. But let's assume that we have $200,000 line available. Now let's go ahead and re-engineer all of this good stuff, right? So we're not going to eliminate the debt, but we're simply going to transfer it. So if we have the 6 credit cards, right? Boy, if we had to save $1,000 when we're here, like Dave Ramsey suggests, I don't even know if that's even possible, right? So let's go ahead and move some of this credit card debt into the line of credit. Again, we're just transferring it. So now let's go ahead and do this. Move $95,000 here. And so what happens just by transferring this credit card debt? Well, guess what? All these go to zero, right? And so now this negative $300 in savings when we're in overdraft mode, where this is the bank's profit center because they're going to charge us. That's how they made their 5 billion, and that's actually less than they made previously because I think of CFPB, Consumer Finance Protection Bureau regulation. But they made $5 billion because we were here, right? But just by simply moving this money, this debt into the line of credit, now we're in the positive. Isn't that amazing? Isn't that mind blowing? Like we're in the positive simply because we moved some of our debt and made our line of credit as our main operating account. And so the actual velocity banking strategy is that you put your entire paycheck into that line of credit, right? You just click a button. You might have $9,000 coming into your checking account. You click that button and then put $9,000 a payment into that line of credit, and then you take your expenses out of that line of credit, right? You take your expenses out, and then after every single month, the balance goes down about 2,700. Okay, 2,700, and it's really easy to calculate this. Now, here's the thing: we have our new savings account. Like our new, instead of just having money actually laying in a savings account, if we need savings in emergency, it's just the limit minus the balance. So we have $105,000 of savings available, right? And so what we do is we just add 1 month, and to get the next month's balance, it's the previous month's balance. Let's see, plus the previous month's interest minus whatever our cash flow number is. So what's our cash flow number right here? It's 2718.32, right? We just take that cash flow number. Okay. Now what we got to do is calculate the interest. So what we do is we get this average formula, right? And then we multiply it by the interest rate, which is 0.1, because the interest rate of a home equity line of credit is usually about 8 to 10%. And, I'm applying for a new home equity line of credit right now. They say it's going to be 8.5, and I told them like what my interest rate right now is currently around 10%. And she was like, "You poor thing." But if you know velocity banking, like yeah, it's great to have the lowest interest rate, but if you apply this strategy, then you shouldn't be that paying that much interest in the most ideal scenario if you follow it to a T. All right, so now we divide it by 12 because we need to calculate monthly interest, and then we just copy and paste. We just copy and paste and see. Let's see how long it takes us to pay off that insane credit card debt that has kept us up late at night. Right? It's insane. And so now we paid it off in about 42 months. So 42 months it has been paid off. And then now let's just write this as our milestone. So 42 months, and I think was it 96K? What do we start off with? 95K. Okay, 95K of that credit card debt. All right, so now let's go ahead for these 6 credit cards. Now we can breathe, right? And so now we got to attack these amortized loans. Take a look at this. We got 2 student loans, 2 auto loans. We got a cheap mortgage, 260,000 at 3%. Which ones are you attack first? Now, I'm going to tell you that from my experience, it's usually the loan with the shortest term, right? So there's 2 things that affect the payment amount, which is the interest rate and the term. And so you might have a higher interest rate mortgage, but if it's for 30 years, it's not going to suck up that much of a payment, right? But if you don't pay it off early, it's going to suck up so much interest. So we don't want to do that, right? But again, there's a debt attack order. So I'm going to show this with my loan calculator, and let's see if I got it set up. If not, we'll set it up right now. All right, there we go. I think we got everything set up correctly, right? And so now we have these loan calculators, auto loan here, and then we got the 2 student loans and the mortgage. Now the cool thing about this calculator is it's going to tell me the balance of these loans after every single month. So if 5 months have passed, then you could see this actually update. So 555. Now how many months had passed? Let me just check. 42 months. So it's possible that a lot of these loans are at the end of their life. but not quite. So here we have that the two auto loans are at 14 grand, right? When we try to pay off that credit card debt. And as you can see here, we have something called the cash flow index, right? So what is the cash flow index? All it is essentially an indicator of how much cash flow this thing is sucking or this debt is sucking. And the lower the number, that's the one you want to pay off. So it's kind of think of it as a ranking system. And with amortized loans, the longer the longer that time passes, depending on the cash flow, or I guess how do you explain it? I guess the term and the amount of payment. Usually the cash flow index does decrease, right? But depending on the type of loan, um, it will depend on how much it decreases. So, for example, you see this 30-year mortgage. Originally it was 237, and then later it's 219. Yet it went from 51 to 17 with the two auto loans, and because the payment takes up so much of a loan and the term is so short, right? And so if we want to actually, I had a column of here of how much payment you or interest was paid. I'll probably add it at the end of the video. But what we do here now, okay, so we're at 42 months, is that we can just take these two loans and then put them in the line of credit and we get back $800 in cash flow, right? So it's about 14 grand. So let's go ahead and do that right here. And I'm just going to go ahead and let's go ahead and do this. And let's add these up. So I'm going to go ahead and add them up. So it's about 15 grand, right? So what we're going to do is we're going to move these two loans into right here, right? So plus 1533.43, okay? Now what happens by simply adding those two auto payments into the home equity line of credit? Well, let's look for those two auto loans, right? So this is going to be 0 and then this is going to be 0. And so now our cash flow has increased to $3,612.76, right? So let me go back here and I'm going to copy this number. So let's copy this number right here. So now what we do is we just simply update these formulas with our new cash flow because our what's it called? our our cash flow is increased just by simply moving those two auto loans, right? And then now let's go ahead and copy and paste. And then we see that, yes, when we focus on these auto loans, then now it took us 1, 2, 3, 4, about 4 months to pay those off, right? So now let's go ahead and add 4 months. So 46 months, and that's going to be okay, so 90, let me do the math here. 95 plus 24 plus 22, which is going to be 141K. Ooh, that's a spicy meatball. All right, so 141K for those two auto loans. And then now we just go back to the loan calculator here. And then, so this was done at 42 months. Now what we do is we update these. So we got these two student loans here, 46, 46, 46, right? And as you can see, the cash flow indexes, usually they say if it's below 50, pay them off, and then above 50 to 100, it's kind of and then above 100, like they're saying like you don't want to pay it off really, but it's okay. I mean, we got enough. I think we got enough cash flow, and so let's take a look here. So if we pay this $26,000 off, we get about $424 in cash flow. So right? So what we can do is we'll just pay them off one at a time. So 26 grand. And again, if you're doing this, just know that that chunking method, which I'll kind of go into more detail when we pay off the mortgage, is more superior than replacing any loan with a higher interest rate line of credit, usually. All right, so now let's go in here. All right, so now let's do this. All right, so now we're going to move plus 26968.69, right? And then now we got to look for that student loan that we transferred, which is this one. And now we add an additional $426, and now our cash flow is $4,000. Oh my goodness, $4,000 of cash flow. Oh boy, wow. It's amazing. It's like magic. At least that's what people describe velocity banking, right? It's like magic when you're actually it's just dumping all of your money into the line of credit. That's what it is. All right. So now let's go ahead and copy this. And so our new cash flow is 4037.02. And so let's see how long it takes us to pay off what we call the undergrad loan, right? So now 53 months is when we paid off that undergrad loan or student loan one. So now we got 53 months here. And so now it's 95 plus 40, so it'll be 135K. Hopefully I'm doing my math right. And then now at 53 months, what's the balance of that loan? So this is this was moved at 46, now 53, 53. So you got 81,000. And again, it's 81,000 to pay, and we get about $1,300 in cash flow. And our cash flow index is a little bit above 50. I think it's safe to move it, to be honest. But again, the chunking method, meaning that you're doing incremental payoff, or splitting the loan into pieces into your line of credit, is probably going to be superior if you're we're looking for to save an interest. But I don't think it's going to be that much. But we'll see. All right. So now let's go ahead and move this 81 grand and take a look at this. If we pay this 81 grand off, we get $1,300 in payment, but if we pay off this mortgage, we get $1,000. That's why it's important to pay the loans off in order, because we don't want to focus on paying off all this $230,000 in the mortgage and get less back in cash flow than paying off this 81 grand. All right, so now let's go ahead and do that, and we're going to do 81 grand here. 81. All right, so let's go ahead and put in this 81. Right. Whoopsie. Screwed up. All right, let's try one more time. Let's try one more time, and then, all right. So now we're gonna move that 81 grand, 81,948.98. Goodbye, professional loan, right? All right. So now let's go back here, and then now this student loan payment is gone, and so now we're at $5,403 of cash flow, right? So let's go ahead and copy and paste that so we remember the actual number. All right, so now let's go ahead and put in our new cash flow number, which is 5403.83. Okay, and so now what we got to do is just keep going and going and see that student loan paid off in 69 months. Ha ha ha, 69, third grade joke. Is it third grade joke? I don't know. Sometimes when I hang around kids, like I feel like my mind has like gotten more innocent, and I was like, oh man, kids have a dirty mouths, and I'm like here trying to, you know, can't soil my own ears. Maybe it's just because I'm getting more sensitive as I'm getting older. All right, so 69 months, and now it's 135 plus 135. Whoa, what a coincidence. Maybe I selected that number on purpose, but now it's 270K paid off, right? 270K. Now we focus on that mortgage. Okay, now we can focus on that mortgage. And so let's go back to this right here, so 69. And then we can see here, okay, that cash flow index is relatively high, meaning that we don't get that much cash flow for paying off this loan, but we still want to pay it off. And why do we want to pay it off? Is because in a 3% interest loan, if you look at the mortgage amortization schedule, you pay 50% interest in total. So after 30 years, you pay about, was it 180? So it's 260 plus 180, I think, if I recall correctly. So we got to focus on paying this. Now, luckily, we have this thing called that velocity banking calculator, which I love to use. So let's go ahead and see if I can open it up. Okay. Now, the cool thing about this calculator, right, is all I have to do is just input these numbers. Where is that calculator? Is it right here? No, okay. All I have to do is input these numbers, and it tells me what the payoff information is. So let's go ahead and transfer some of this payoff information. So it's 2260000, and the current balance right now is 226445.11, 226445.11. The interest rate, right? The interest rate is 3% for 30 years. And what is the balance? or was the payment 1096.17, 1096.17. And then let's leave the chunk amount for now, but the chunk amount is how much are we transferring into the line of credit. I really think that people get too hung up on this. Like, the optimum amount is just a low amount. It really is. So the way that I think about this is kind of think about like you're using a line of credit as an easy way to prevent segregation of income and to overpay the amortized loan, but you have to understand that this is a 3% loan versus a 10% line of credit. But even though it's a 10% line of credit, if you as long as you don't put the entire thing into the line of credit, right? You should be fine. Like a small amount comparable to your income. We'll use like $10,000 to $15,000 chunks. As long as you have the cash flow, it'll offset the interest, right? And I'll show you what I mean by that. So what is our income? Let me just check the other spreadsheet. It's 9 grand, but remember when we first started, we were at 9 grand negative with negative cash flow. And then our expenses are everything except for the loan we're trying to pay off. So we're assuming that we have $2,500 in expenses. Now let's do this, okay? Let's assume that we decided that we're going to replace our $226,000 mortgage at 3% with a huge line of credit, like 226.445.11, what they call a first lien HELOC, okay? And let's record the results. So as you can see here, it takes us 3.5 years to pay off and 42K of interest with a first lien HELOC, right? Looks impressive. Wow, we're saving $50,000. Okay, let's just do this. Let's do, instead of replacing the whole thing, let's do $10,000 chunks, meaning that we just move $10,000 of the principal to the line of credit and then do the strategy. Oh my goodness, look at this, right? It's 3.1 years and 11K in interest. So what would you prefer? 3.5 years and pay an additional 30K and leave that on the table, or 3.1 years, which is even faster, and only pay 11K and save 30,000 in interest. I don't know about you, but I don't want to leave 30K on the table because that could be like a free car for me, right? I don't want, even though I'm accelerating and paying it off, that, like, saving money, I'd rather save even more money, which is why this chunking method is awesome, because it allows you to easily pay off your mortgage without giving up access and control to your money, right? Because we're not engaging in that segregation of income. And if we directly overpay the mortgage, we lose that money. It's much harder to manage our finances. Okay? So this is why we don't really mess with lines of credit, or I'm sorry, first lien HELOCs here until our mortgage is paid off. But let's go ahead and do this. So let's say like, oh, it's $9,000. So compare 9 and 10, right? Well, actually, this is interesting for some reason. And I'll have to play around with the calculator, but I use the calculator to kind of estimate like what's the best optimal, but I don't have a real, let's say, answer of what the best chunk is. It's always just somewhere near your paycheck. But let's do 20 grand, okay? 20 grand. You see, it's how about like 13 grand, but 10 grand. Oopsie. But if I do 10 grand, it'll be about 11, like almost 12K. Let's do 15 grand. See, so when I did 9 grand, for some reason the interest is more than 10 grand. I don't know why, but all I know is that I just kind of a safe amount, it would be somewhere near your monthly income. Okay, well that's it for today. Yeah, so ooh, how long did it take us to pay off all that debt? I probably need to record that milestone. So let's just do the final recording of that milestone. Go back here. And so now it's 3.1 years. So what we do is write 69 divided by 12 plus 3.1. And then that would be 8.85 years to be debt free, including our mortgage. We didn't pay off our mortgage in 8.85 years. It's 8.85 years plus, or I'm sorry, all of our debts, student loans, credit cards, auto loans, and the mortgage in 8.85 years. So you remember you see those velocity banking advertisements, pay off your mortgage in 8 to 10 years. No, not our mortgage. Our mortgage took us 3.1 once we've maximized our cash flow from paying off our other debts. Okay, well that's it for today, everybody. So how much debt was that? It's 270 plus 260. So let's just do a final tally. And then that was, let's see, I screwed this up. So 260 plus 270. That was 530K in debt. Oh my goodness, 530K in debt. I mean, think about how many doctors could be helped by this. You know what I'm saying? All right, well, that's it for today. Have a great day, and we will speak next time.